Today, we are going to be reacting to one of my favorite clips from The Big Short. And as a third generation loan officer, where my dad's been in the business for over 40 years, his dad before him in it for 40 years as well, I have a very interesting perspective when it comes to being a loan officer. I'd like to say I know a little bit too much, especially as a 26-year-old loan officer. Most people would be pretty surprised as to what I can speak on. You know what? Let's just get into it.
So how many people have you talked to about this trade?
A few. There's definitely some interest.
Oh, my boss would have my ass.
You crazy, Jim?
Not gonna-
Get lost.
You. I just had to pause to laugh.
A few people have invited us in just to laugh at me on this deal. Is that you? Is that what this is?
That's not what this is. That's just how Mark is. Let's see what you got.
Sorry.
These girls like about to laugh.
What?
What's that smell?
The cologne?
No.
Opportunity.
No. Money.
Okay.
I smell money.
Okay.
Oh,
Chris. God damn.
Sorry.
This is your
yes,
basic
I remember the
mortgage
saying.
loan. All right? The originals were simple. They were just thousands of AAA mortgages bundled together, guaranteed by the U.S. government. The modern ones are different.
So for context, AAA mortgages, when they are talking in regard to AAA, AA, it is a rating system for where those mortgages, based on their risk level, where those are put and what kind of bonds they're being put into. So if you got a bunch of AAA type mortgages, then they're going to be packaged all together, which they're going to be good FICO scores, so high credit scores and good income qualification. In other words, lower risk is going to be rated higher. So your yield's going to be lower because your risk is lower. It's like investing into a Roth IRA or just an index fund. Like it's just going to grow 5% year over year, and it's not going to really do crazy things, not going to be crazy volatile. But that's the general idea, because bonds are made up and it is a bunch of like-kind mortgages packaged into one bond. So let's just say we take a bunch of $100,000 conventional mortgages and we package it into one $10 million bond, and then it's sold. And of course, as you can imagine, $10 million, if it's paying a yield of 5% annually every single year, that's pretty solid.
The highest level AAAs getting paid first. The lowest rated Bs getting paid last, taking on defaults first. Somewhere along the line, these Bs and double Bs went from a little risky to dog shit. Where's the trash?
Behind you.
I'm talking rock bottom FICO scores. No income verification. Adjustable rates, dog shit. The default rates are already up from 1% to 4%, fellas. And if they rise to 8%, and they will, a lot of these triple Bs are going to 0 too. And that, you're too close, is an opportunity.
Okay, you're saying that at 8% the bonds fail and we are already at 4%?
That's right.
If they go to 8, it's Armageddon.
Yeah, that's right.
How come nobody's talking about this?
I'll tell you why no one was talking about this is because the amount of money people were making from selling these bonds back and forth, getting fees for doing so. It was stupid money. My father talks about this time all the time. And if you talk to anyone that's been in real estate between 2000 and 2006, money was just flowing like crazy. And I have a rule of thumb: if things are too good to be true, they usually are. So if they seem a little too good, then you might need to be looking as to why that is. It was wild.
So you're offering us a chance to short this pile of blocks. How?
With something called a credit default swap. It's like insurance on the bond, and if it goes bust, you can make 10 to 1, even 20 to 1 return.
So it's just a fancy way of saying I have a way to short these bonds. If you don't know who Michael Burry is, he's the one who essentially got famous for shorting the housing market, and the credit default swaps were the way that he was able to do that. And he actually went to Lehman Brothers and had them create the product because they did not even have that as a product that they offered to any investors. So pretty crazy there.
And it's already slowly going bust.
10 to 1, 20 to 1? No way.
And no one's paying attention. No one is paying attention because the banks are too busy getting paid obscene fees to sell these bonds.
But wait, you are the bank. When you work for the bank, I bet your margins are pretty nice and fat.
Let's not talk about my margins, by the way. Being nice and fat. That's a nice shirt. Do they make it from End?
Aren't you the bank?
I work for the bank. I'm standing in front of a burning house, and I'm offering you fire insurance on it.
How can these underlying bonds be as bad as you say? It wouldn't be legal.
Nobody knows what's in them. Nobody knows what's in the bonds. I've seen some that are 65% AAA rated, that I know for a fact are filled with 95% subprime shit with FICOs below 550.
So what he's talking about is subprime mortgages. Traditionally, bonds are sold to Fannie and Freddie Mac, which are government entities, and you have to do income verification. There's only a certain amount of people that can qualify for a home loan. So Congress allowed banks to be able to create new programs that allowed for more people to be able to qualify for homes and home loans. And they were called subprime mortgages. The most common you'll hear is the Nina loans, the no income, no assets. They even had a no income, no job in assets, a ninja loan. People were actually even qualifying and putting their dog's name to qualify. The goal was to create subprime mortgages to help with people that maybe not be able to show income on paper. There's not enough loans to package and put in these bonds because all these bankers are making so much money selling these bonds. So what did they do? They created a new programs, which is subprime. They created a new market of bonds, which is essentially a bunch of subprime mortgages packaged into together to create a different type of bond, which is sold more privately and making obscene fees selling these bonds. And then the loan originators are going to be pushing those products like crazy, but they didn't require any income verification or credit score requirements or anything like that. It got so crazy. Essentially, they created a brand new market, pretty wild, but now subprime mortgages are not around, which is good.
You think we just warehouse it on the books? No, we just repackage it with a bunch of other shit that didn't sell and put it into a CDO.
A CDO.
Yes, a CDO.
What is that?
This is where we take a bunch of Bs, double Bs, and triple Bs that haven't sold, and we put them in a pile. And when the pile gets large enough, the whole thing is suddenly considered diversified. And then the whores at the rating agency give it a 92, 93% AAA rating. No questions asked. Here's world-famous chef Anthony Bourdain to explain.
I forgot about this. This is such a good, so good.
Okay, I'm a chef on a Sunday afternoon, setting the menu at a big restaurant. I ordered my fish on Friday, which is the mortgage bond that Michael very shorted. But some of the fresh fish doesn't sell. I don't know why. Maybe it just came out halibut has the intelligence of a dolphin. So what am I going to do? Throw all this unsold fish, which is the triple B level of the bond, in the garbage and take the loss? No way. Being the crafty and morally onerous chef that I am, whatever crappy levels of the bond I don't sell, I throw into a seafood stew. See, it's not old fish. It's a whole new thing. And the best part is they're eating 3-day-old halibut. That is a CDO.
Such a good example. And it was just a repackaging of crap that was sold. And everyone was sold on these terms associated with positive and didn't really take the time to actually analyze what they were actually being sold. But people weren't losing money until later when people started defaulting and those bonds became useless and completely worthless. And people lost their homes in the millions.
The banks have given us 25% interest rates on credit cards. They have screwed us on student loans that we can never get out from under. Then this guy walks into my office and says, those same banks got greedy, they lost track of the market, and I can profit off of their stupidity. Fuck, yeah, I want them to be right.
Honestly, people forget that people are just people. And sometimes we put certain people on a pedestal or certain careers on a certain pedestal, and then therefore we put the person on a pedestal. For me, I always make sure that my greed's in check, and greed is the problem here. Everyone didn't care. Everyone was greedy because they didn't care enough to look behind the veil, because at the end of the day, they were making so much money that they just assumed that I just need to hold out for a couple more years. I should be fine. But not when you have a financial collapse.
How come you don't hate this guy? He's everything you taught us not to trust.
I can't hate him. He is so transparent in his self-interest that I kind of respect him. Would I buy a car from him? No. Is he right about the mortgage market? Let's find out. Let's find out. Look, it's two very simple questions. Is there a housing bubble? And if there is, how exposed are the banks?
Turns out, very. The only way that we see any sort of housing crash or any sort of issue there is we need a supply shock. So what would create a supply shock? Well, let's start with, why is there a supply shortage in the first place? For one, we have low interest rates across the board. We have a ton of current sellers right now that don't want to sell their home because they have a 2 or 3% interest rate. I don't know about you. If you're trying to buy another home, you probably want to get something bigger. If you get pre-approved and you end up being able to qualify for the same home you're in, then it makes no sense to buy. Duh. So that's been the problem for the last few years now. So the only way for people to want to sell in droves, it sucks to say, but we have to see a huge spike in unemployment, because regardless of how low your interest rate is, you can't make your mortgage payment if you're not making any money. It goes liquid assets currently, so savings, what's in your checking account, investments to keep yourself living. Then it goes liquidatable assets. Then the last it goes is typically going to be the house. So until that happens, we won't see any sort of big correction. And if you're looking to learn more and be entertained, learn how to buy a house, improve your finances a little bit more, this is going to be the channel for you. So don't forget to subscribe. I always appreciate that. I'll catch you guys in the next one. Peace.